Running our own business isn't easy, and it can be a tough gig for all of us at times, and only other business owners truly understand the challenges that we face. And on ScaleUp Radio, we aim to help make things just that little bit easier by interviewing guests who have been where you are now, regardless of where you are on the scale-up journey, and maybe facing some of the challenges that you are facing. And they offer their thoughts and advice on what has worked well for them, as well as what didn't, of course. And we've also combined many of these lessons into a practical scale-up handbook called the Entrepreneurial Scale-Up System. And there's details of this at the end of the episode. So welcome to ScaleUp Radio. Welcome to another episode of ScaleUp Radio. I'm joined today by Julie Wilkinson, who is the founder of Wilkinson Accounting Solutions. So Julie, welcome to ScaleUp Radio.
Hi, thanks for having me.
Yeah, brilliant. So Wilkinson Accounting Solutions, I know you're not just any old accountant, are you? So would you like to tell us what you're all about?
Yeah, so we're accounting and consultancy, probably move into a bit of the corporate finance sector as well. We basically specialise in business acquisitions and exit planning. So we have a specialised team of people that help our clients with valuations, pitch decks, cash flows for funding, looking at full due diligence on deals, so operational, financial and tax. We look at entity and corporate structures, like tax structures and, especially for things like earn-out trusts and management buyouts and areas like that. We also have, because we have our accounting team, we also have our post-acquisition consultancy. So we work with our clients on helping them integrate like a financial infrastructure after they've bought it, if it isn't in place prior, which we often find because sellers aren't often ready. And then from a sell side, I mean, we do similar services on the sell side to the buy side, to be honest, so they can have the valuations. I mean, we do try to entice that sellers get themselves set up, so get the infrastructure in place before they sell it. Obviously, that's better for the buyer. It's better for everyone, really. But obviously, we know the reality is that most businesses aren't set up that way. So buyers do tend to get some good deals, and then we work with the buyers, or buyer and seller do work together often. They do come together, like mediate throughout the due diligence process where, you know, the seller will say, right, let's hold it for 6 months. I'll get my books in order. And then the buyer buys it at a point in time once we've tidied it up. So we're finding that's happening more and more.
Very good. So what got you into that side of things?
Well, the history is I came from corporate. So my last corporate job was a 250 million retail company, and I had some projects in that company. And one of those projects was to integrate 3 entities into the group entity. And one of those entities was a family-run acquisition. So they had purchased this business, albeit some time ago. I wasn't involved in the acquisition, but I suppose I was in the post-acquisition stage.
Yeah.
And what I realised, that was probably my first ever insight into a smaller business, really, a family-run business, because I'd always obviously worked for sort of the big corporate company. And what it came to light was, it was quite poorly ran in terms of processes and infrastructure, which I'm not always saying corporate companies are run well necessarily, but they do have good structure. That's one thing that they do normally have. Yeah. So obviously my role at that point was to bring the structure in. So anyway, fast forward, we did that project. And I did a survey and I asked 20 businesses what their accountants did for them. And 100% only saw their accounts once a year. Well, 100% of them saw their accounts once a year. So I thought, oh my goodness, I couldn't believe, and this was businesses of different sizes. So I picked businesses from about 50,000 to about 20 million turnover. And I just did a variety just to see. And then I went and spoke to accounting firms and I kind of asked them. And the feedback I had was, businesses don't value management accounts. They don't understand it. They don't see the need for it. It's hard to sell it. And I found this strange because I was like, in corporate world, nothing would get signed off without, maybe it's overkill in a corporate world, but in principle, a basic return on investment and cash flow for things.
Yep.
But then when I sort of investigated, well, what sort of experience did accountants typically have? What were they offering? What I realized was I had a skill set, because at the end of the day, I had 20 years in finance. I mean, I started life as purchase ledger, worked my way up. I was a chartered management accountant by trade. And I realized, you can't really teach 20 years experience. What I found was, I'm not saying all, because I don't like to silo, but a majority of practices seemed quite, they were quite silo in their experience. They kind of did bookkeeping, tax returns, backward looking, hadn't really ever had exposure to elements of, real life, sort of what I would call supply chains, commercial analysis, whereas I had worked with all directors of a business through all parts of the supply chain for years.
Mm-hmm.
So I just think that gave me a bit of what I thought was an advantage. And that's where it started, really. How I got back into acquisitions was I did some CFO work back when it was just me. And a broker, some broker firms came to me and said they were still involved in that business. And they said they were so impressed with what I'd done, would I consult for them? So that was how I got back into it, is I just consulted for other people at first.
Right.
And then decided to sort of build my own infrastructure, build our own services, get our own team in, which obviously took time. And here we are now.
All right. Good. Well, we'll explore that journey in a minute. So how does can you give us a feel for the size of the business? And you said you built a team now. So where are you now?
Yeah, so we've got 9 employed staff. Yep. We work with about 18 in total because we've got some freelance. So we've got like 7 CFOs that work with us on different projects, like as required. But the market is quite variable, like it happens at different times. So we often are in discussions on like normally working on 3 to 5 projects at any one point in time. So that could be anything from sort of basic valuation reports through to full DD, because normally when we work with clients, we'll be helping them at different stages, and one deal might fall through and then they'll be waiting for another one. So that's kind of just how it goes, really. So it goes up and down. I mean, we did actually buy our own acquisition. So we also bought some clients off a retiring firm.
Mm-hmm.
And we're looking to do more of those acquisitions as well, because that's kind of how we build our retainer-based clients.
Okay.
I think with the services we offer, we typically, our organic services are normally coming through the consultancy, sort of larger projects, larger business sizes, probably over 500,000 turnover. Whereas we're looking to grow by acquisition ourselves, which we did one this year. And we are looking to do probably a minimum of 3 more over the next sort of 12 months.
Okay. And that's bringing on not just the client fees, but also the people that come with that, the staff.
Yeah, so we'll take the people, yeah.
Yeah. No, okay, very good. So, and you mentioned there's obviously a split between retained work and maybe more ad hoc consulting type work. So how does the business model work typically for you?
So we have team members, everyone from sort of finance assistants all the way through to our CFOs.
Yep.
And basically different level of people will manage their element of the process. So, we do have some back office offshore teams as well that sometimes help us with some back office processing. But so we have sort of an assistant finance and payroll manager who oversees all the payroll. We have our bookkeepers and finance assistants in the UK who are sort of like, I suppose, the client managers for the bookkeeping. So that's their day-to-day contact with their bookkeeping queries. And then I have a group CFO internally who heads up most of our consultancy. So obviously, we'd utilise our internal team first, and then we go to our outsource if we have multiple projects, which is really difficult to predict. I mean, we sent 6 quotes out in one day for acquisitions last week. So I have a feeling September's going to be busy because we had a lot. I mean, I would say over August, we sent out about 20 quotes for sort of acquisitions and consultancy. But, a lot of people are on holiday. So we can see September, October being quite busy.
Sounds good. And how does the money flow? Is that on a consultancy charge per hour sort of basis? Is that on a percentage of the acquisition, or how do you charge for your services?
No, we normally try and do fixed like project prices.
Yeah.
And that can be different depending on the project. So acquisitions, we normally do a set fee, which is based on the value. It's not usually a percentage. It's just it's a set value based on the type of DD they know and the size of the deal. Yeah. Post acquisition and more ongoing consultancy, which is like more regular, I suppose, because that can be anything that normally is sort of like a weekly fee. Right. Maybe we bill it monthly, but we look at it weekly of so what we normally do is look at who needs to be involved in the project, and we sort of project price that. We don't we don't tend to just do like freelance CFO. So the person doesn't tend to just go in for like 5 days a week, because most people don't really need that. We'll use a mix of our skill set, and we'll do a like amalgamated price, which often makes it more cost effective, because where they might just be thinking, I need a FD 5 days a week, actually that might be too expensive for them. Mm-hmm. And it might be what they actually need is just a finance assistant for 3 days, a finance manager for 1 day, and then a FD for 1 day, to oversee the project rather than the FD doing the work. Yeah. So I suppose what we've set up is sort of a virtual finance team. So the same finance team a corporate company might have in tens or hundreds of people. Yeah. We have that same setup, but for an SME business, that might only need a quarter of a person a week or something like that.
Yeah, so an SME can have not just a fractional CFO, but they can have a fractional finance team.
Yeah, basically, yeah, which really is what they need.
Yeah,
because nobody can afford. Most people need a mix of skill sets. So they need a mix of a payroll and finance manager, a mix of a bookkeeper or finance assistant, or maybe some people might know that as purchase ledger, depending on how big the company is. With probably part commercial accountant and part CFO. And I suppose in a corporate company, the year end would probably be the financial accountant, so in a corporate company, you'd have probably 6 to 9 roles. And then you can streamline them down because like one person can have multiple skill sets. So a finance manager, for instance, is usually more multi-skilled than say a management accountant. So that's what you typically do in smaller businesses. You'd pick more experienced people.
Yeah. So you'll do the basic compliance work as well, but you tend to be more strategic with acquisition-led aspects of the business by the sounds of it then.
Yeah, normally we do. Well, it depends. I mean, we're not always here just to, they might have their own accountant that they're happy with, and that's fine. I suppose because for us, the tax and the bookkeeping is such a small piece of the puzzle compared to all the big stuff we do. For us, that's an easy add-on. Yeah. But what we do sometimes do, because of the size of companies we work for, and obviously when people are buying multiple companies, we do tend to find actually some of those roles do benefit them in-house anyway. So especially sort of the lower level, like the bookkeeper, maybe not on one company, but once they maybe get to 3 or 4. So we also help people recruit, train, onboard and mentor staff. Okay. So we do things like we write their governance and control process. We help write all their process notes and do their training and onboarding. And we have actually done that at FD level as well, if on the odd occasion. Because obviously once someone gets to about 5 companies, the reality is they probably do need, at that point, they might need a full-time FD anyway. We sometimes then still stay on and help with the ad hoc project. So if they do another due diligence, as an example, we might then stay on and do the due diligence. But, they need somebody to be running these 5 companies that they've already got. Yeah. So we kind of like bridge the gap. We help set up the infrastructure, set the process up, then bridge the gap between when they might need people in-house versus maybe not, depending on where they choose to go.
Very good. So what does your typical client look like? You mentioned different sizes of client, but what's your typical ideal client, perhaps?
Well, I would probably say over 500,000 turnover. Normally they have excess of 3 or 4 staff. I mean, on the buy side, we would work with the entrepreneur who's buying the businesses. Now, that can either be a business owner or it could just be an entrepreneur who's got cash and wants to buy businesses. So the buy side is quite easy. I mean, that's either an individual or it's a company, and that can come from various routes. So often an acquisition is a good route if someone is looking to exit. So, if someone comes to us and says, I want to exit, we have a few key questions. Do they have an idea of how long, what they want the business to be worth? Who are their management team, and do they have a forecast of how to get to that exit? They're kind of like the 4 key things really that the business needs from a financial perspective to sell the business. And we would help them, I suppose, integrate those key components. So you'd be looking at, if they said, well, I don't have a management team, they would be like, well, you need to get one. Yeah. You need to start getting one. Now that might mean you need cash. So therefore we know they need to forecast, well, when can they afford that cash? So that might lead to a bigger piece of work, because maybe we have to do the business plan, financial forecast first before they leap in to like getting the management team, because they don't know what cash they've got. But what we do typically find is, in the end, people that have a relatively quick growth, they want to sell in 3 years, then acquisitions does normally fall part of those discussions, because we know that the acquisition accelerates the growth. Yeah. So, and people haven't always thought of it before, you do the work, but obviously it can come up as part of the conversations, because it does help accelerate it. So
definitely. So I'd definitely like to get into a little bit more detail with you in a moment about the acquisition strategies and when we should think about doing it as business owners, if at all, if it's appropriate for it. Before we do that, can we just go back for your journey? So you came out of corporate, you set up on your own, and you did some consulting, and you've now got to the point where you've got 9 full-time staff, and you've got a number of CFOs that you have on contracts and things. So take us through some of what you've learned along your scale-up journey in terms of scaling and running your own business.
Yeah, well, it's difficult.
Yes, it's not easy, is it?
Yeah, so I suppose, because a lot of people ask me, because I mean, I've only had it, I set it up in 19. I didn't officially start training until Jan 20.
Right.
So it's now sort of just over 3.5 years.
Yeah.
I think I knew, so although I came from a CFO sort of finance background, me personally, I wasn't, which sounds a bit strange, I wasn't actually, I think one of the reasons I got a bit bored in jobs was because I like new projects and I like that entrepreneurship. And I think me personally, I didn't really want to work in finance anymore, which might seem a bit strange because it's just a finance company. Yeah. So, but I think I always had a mindset that actually I knew there was a gap in the market. There was a lot we could offer, but that didn't mean I had to do it. I think I always started with that mindset. So I didn't always know the my full exit strategy right at the beginning, but I had like ideas of like what I wanted. And because of that, there were certain things that I did right at the beginning. So for instance, I always outsourced a lot of things right from the beginning. So I brought in outsourced bookkeepers from the beginning, even though typically I probably could have done it myself, I didn't. Yep. I did things like brought in IT firms quite quickly to like manage all my IT, and get all that sorts of things. So I didn't, because I managed the cash flow so that I didn't see it as money going out the bank. I saw it as what I was gaining.
Yeah.
And I also didn't take on too many small clients. So I did like push back and say no to quite a lot of things because I knew that in the end, if I wanted to do the big project work, I had to have the time to build the team. So when I left, so I did start the business a bit later than I wanted to because it was a bit of a long story, but I was meant to go part-time. The reason I worked all of 19 was because I handed my notice in. I got like a part-time role of my job. So I built up some cash and I was meant to leave my job in July 19 and start working on the business full time. But I just happened to get an FD contract in London, which I chose to take because it built up a bit of money in the business bank. But what I realised towards November, December of that year is I'm not really moving forward because all I was doing was swapping time for money. It was fine. It was well paid and stuff. And that's fine for some people. But that wasn't really my idea because my idea wasn't really to do the job. Yep. So I decided to end that contract. And obviously it got to about Jan 20. And then obviously we know what happens in 2020, don't we? COVID came, which was a bit of a problem because I had no online presence.
Yeah.
I had nothing. I mean, I didn't come from a practice background, so I had no clients. I didn't have clients that I worked with because obviously I came from a corporate and I had no online presence. But I thought, I've done it now. So anyway, I managed. So what I did initially was I got, I suppose I still got contracts, but I changed the setup of them. So that's where I started my project. So I always knew I didn't want to swap time for money. So I always set it up as a project-based mindset. So I went in on, even when it was just me, I tried to go in at project-based rather than day rate price.
Right.
Because I thought in the end, that's how you price when you've got multiple team members working, because it doesn't really work when you're doing big projects like that.
Yeah.
So that's how I first changed. And I managed to get, I had a couple of them. And then when I launched into, and then I did obviously the contracting for the consultancy for the acquisitions. And then I think I launched the acquisition services officially around about summer 21 in Wilkinson's. And then our group CFO got employed last year around May 22. So he's been here a year. But because we could see the pipeline building, and we do have a massive pipeline of sort of people who have already bought through us or want to acquire. And even just ad hoc consultancy like part investors that want to sense check numbers. We do a lot of what we call sort of top level valuation reports for people to get before they start moving to expensive DD and things like that. So yeah, we are pretty busy on it.
What have you learned along the way?
The type of client that we want to work with. Obviously, we're aware, we're good at cash flow management and reporting, but we still have this. Just because we're good at it doesn't mean we don't have the same struggles. A consultancy-based business is hard because we're no different to anybody else. It is ups and downs. And this is what we try to say to people, like, just because people think, oh, I can't forecast because I don't know. Well, the point of the forecasting is you go for what you need. You don't let people just come to the ideas. If you want them to run the business, you have to like know where your market is, and who you're targeting. Rather than just always relying on the same type of referrals and the same type of thing. That we've always really diversified in terms of our sort of social media and how we sort of promote and go for new clients. How
do you do
that? Well, so I run a podcast, which is, I've had nearly 2,000 downloads now. That does really well. I do really well from the podcast because obviously that's in the build. It's called the Build and Exit. So it's in the acquisition space. LinkedIn. So, we get a lot of traction through LinkedIn. We launched TikTok last year. And we do Insta. So we launched Instagram this year. And I do have a page on Facebook as well. We do have SEO. And sort of like email marketing, and then we do get referrals and things because obviously we're really well connected to brokers, finance brokers, business brokers, and often they like to work with us, or past clients are through, because they need the help either on the exit side or the acquisitions.
Okay, very good. So I interrupted you with saying what else you'd learned. Maybe some of the things that you got. Well, what have you got wrong along the way? What hasn't worked quite as expected?
Well, I think the reality is, when you're in a service industry, it is hard because people do just buy into you. And obviously, I had that right at the beginning. I mean, we still got clients now that we had when it was just me. And I think just trying to get other people and processes in place to work as well as you. I mean, that has been a learning curve, and we have got stuff wrong. But I think what I try to do, I mean, and one of the things personally I do, so I've gone on a wellbeing journey this year. So I do a lot of meditation. I do a lot of meditation manifestation. I have a whole morning routine of journaling, and because it's the only way I keep saying, because it is hard, because there is a knee-jerk reaction, I think, when something goes wrong, not to step in and fix it. But I'm like, but if the business is going to run independently, the teams have to be able to manage, we have to be able to have good customer service as a business. And, there is a risk in that. And things can go wrong because you're training and relying on other, and we have to have enough checks in place to mitigate. And I think most of the time we do. But obviously things that, that is a big learning curve, picking the right people, making sure they're the right fit. We do a lot. We're trying to bring in wellbeing and sort of belief coding that for our own staff, so that they get their own sort of wellbeing training and confidence boosting and things like that. Knowing the roles, the level of roles, it's difficult to always know. I mean, the consultancy works really well. My group CFO, Tilly, who's like my right-hand man, he's amazing. And, the consultancy goes really well. I think, it's making sure we've got the right skill set to do all the right roles and training, because the team's grown really quick, really. I mean, this time last year, I think we only had 2 employed. So plus we bought the acquisition this year. So not only have we onboarded all, and some of those employees came from the acquisition. So not only have we employed new staff, we've then brought a new company and brought in external staff into the team. So there's always there was always going to be learning curves with that within a year.
So how are you making sure you keep control of that growth and manage it in a way that you keep the quality high and all your systems in place?
Well, we have got some good reporting. So I'm not saying we're fully systemized, but we don't have any paper. So we're all virtual. We don't really have any paper. We're all online. We have a tracker and task list that the team go into every day that has all our deadlines. So we know what tax returns are coming up due. So to be honest, we never really miss any deadlines or anything like that, because that's fine. That's all in place. We know when everything's due. I think it's the process and the training. So we do have like SOPs, standard operating procedures, which obviously we've had to develop because a lot of this has only grown in the last year. So we've had to develop as we go. And we just make sure that we review things at the point that we feel we need to. So we do a lot of reconciliation. So like our bookkeepers, for instance, will always reconcile every quarter, and then they'll always be signed off by more of a senior person, so that we can check the balance sheet integrity and things like that, which is what we advocate to sellers that don't have good finance support in place. These are all the things that we do for the clients when we do the ongoing bookkeeping. And obviously, we just make sure we use the right level for the right staff. So, our CFOs will always oversee the top level projects, so our big projects will always be overseen by one of our CFOs, because we wouldn't be able to do it any other way.
Good. And what about the culture? Because you mentioned you've already done one acquisition, so you've got a completely different team coming in with you. How do you keep the culture as you want it to be within Wilkinson?
Well, I feel we're pretty open. We'd like everyone to be able to talk, and we're happy for people to feed upwards as well as downwards and sideways. There are challenges, because obviously when new people come in, and it's them learning. I think a lot of our staff have come from a corporate background as well, not always from practice, which we like that, because it brings a different level of experience. But I think working with a lot of clients can sometimes be challenging. So it's just making sure that they've got the right diary management. And we have a PA, we have a PA. So we employed a PA who mainly looks after it, but she also helps coordinate some of the diaries and the meetings and things like that. But in terms of we have our own reporting. So we have all of our reporting on our ROI and our marketing. We have our own management accounts. We have our own cash flows, 12 weekly cash flows, which all different people in the team prepare different things. And then we have a weekly review of them.
Okay, good. So if you were to look back over the last whirlwind of the three and a bit years, what would you, if anything, what would you do differently?
I don't know. Well, I think, I don't know. I'm trying to think now. Sometimes maybe we're a little bit slow to be decisive on decisions. So if we think something's not working, it prolong a little bit. And we have it's been a learning curve because of the pricings of the acquisitions. When do you charge the customer? When do they pay?
Right. Yeah.
Consultancies. So because of that, we have had some learning curves on cash flow challenges internally. And so we always just review our processes, but we are pretty set out because we're fully cyber secure. So we're cyber accredited. We've trademarked. So we've got all the right security and stuff in place as well, because to make sure that we're fully set up and secure.
Yeah.
So I definitely think making decisions a bit quicker. But I don't know, differently. I never really look back at anything and think, it was the wrong decision, because I don't really believe there are any wrong decisions. I think as long as you learn and you act, you always make the decision. Well, I feel I do. I make the decision based on what I know at that time.
Yeah.
And then at the end of the day, we will always reflect. Obviously, if something goes wrong, or if we think we've made the wrong decision or something, then we'll reflect on it and look at why. But I always think that leads to a bigger and better decision in the end anyway.
Yeah. Oh, good. So what is it you love about what you do?
Well, I love the interaction with customers. I'm quite I love the podcasts. I do a lot of talks. I'm going on a bit of a professional speaking journey. I'm actually going to LA in September, speaking at the LA Business Show. I did get an interview on live TV a few weeks ago. Right. And I love the podcasts. I love interacting with the new customers. I'm also running my first masterclass on the 5th of September.
Okay.
So I love the acquisition industry. I love sort of the M&A world. And I think there is a gap of finance knowledge. I know because I speak to a lot of people that come from a lot of some of the big training courses in M&A. And I have a lot of feedback to say. There's a lot of teaching out there on how to find deals, negotiate deals. But actually, the reality is, and I just know this because we probably see about 100 balance sheets a month.
Right.
I know from speaking to those business owners that I'd say 98% of business owners typically don't really have a full understanding of financial statements.
Yeah.
That is the theme we've seen over the couple of years. Now, that can be anyone from the buyer not understanding to the seller not really understanding their own financial statements, because what we find happens is traditional accounting, which I would sort of say is quite backward looking. It's a needed task, but it is backward looking because it's always backward if you're preparing something that's already happened.
Yes.
Once a year isn't enough.
Nope.
Especially not for these size businesses. And then it's the understanding of that information. So a lot of people will say, oh, my account's brilliant. And they say they sort everything out for me. What they actually mean is they give me a good tax bill, because they'll say, oh, I understand it. They get a profit and loss and a tax number. But as soon as you move to the balance sheet, they will say, oh, I understand it. But you pick a few numbers out and they never understand what it actually means. And I'm not saying they should. And it is difficult for accountants. I know because we do accounts, like for non-financial people to actually have the understanding of what they mean. But it's down to the business owners to take the time to listen, because I think they don't tend to listen unless there's something happening. Yeah. So if something goes wrong or then they want to sell, they take more interest. But I think over the years, on average, they kind of just maybe not bury their head, but it all happens last minute. You know, they just want the lowest tax, you know, they're just like interested in, oh, what am I paying this year because it's been left so late. And there's no, and, you know, because there's cash in the bank, they think they're making money. And that's obviously the biggest mistake that anybody can make, because we all know you can have cash and not make profit.
Yeah.
And that is what a lot of people happens. And we do see, I have seen like most balance sheets we see probably always have a minimum of 10% risk. That's generally average. Some have a lot more and some have closer, which is obviously not great. And the reason this always happens is because of poor or late accounting, because you'll find most of the time there's 18 months worth of taxes not in the trial balance.
Mm-hmm.
You'll see accounts being posted anywhere on the balance sheet. So all these uncategorized assets, oh, it's okay, we tidy them up at year end, but then 3 years, but then there's a transaction that's been there for 3 years and it's never been tidied up. We see it all the time, from small numbers through big numbers. I've seen things like 7 million sitting in payroll control accounts on the balance sheet. And it's like,
wow.
The business owner will go, oh, it's okay, my accountant's audited, but it's not okay, because that might be okay when the account does it offline for the tax return, although is it? Because how have they done the brought forward? But how is it okay for your day-to-day management? The fact is, even if you have a freelance CFO or, you know, some bookkeepers things, as a business owner, nobody's there 100% of the time for you to make decisions. Yeah. And we have people coming out my podcast, which is why my podcast is quite interesting. You know, people have said that they think they've tripled the value of their business just by understanding finances. They didn't do it. They still use finance teams to do it, but they understood it. And by understanding it, they could make quicker decisions in terms of how they accounted for things. So key things that always go wrong are things like deferred revenue, accrued revenue, prepayments, accruals. I mean, and the average business owner often just goes, oh, I don't like accrual account, and you can manipulate it. But the reality is you can't have accurate accounts without it. And if you're using the right people, then it won't be manipulated. The fact is they don't understand it enough to challenge it, so they get scared of it. That's what I see is the reality of it.
Yeah. Okay. So that's a big frustration for you, but also a big opportunity for you, is that the most of us as business owners we could just about get our heads around the profit and loss statement. Probably don't even use that properly and check that that's being put together properly. But as you say, when we come to balance sheets, we will go, okay, well, I'm not really, there's some assets on there and some whatever else, but how else? So how should we be using the balance sheet in our businesses?
So the balance sheet is key for cash flow, because that is, so basically the simple of bookkeeping is each transaction has 2 entries. That's why it's called double entry. It's called double entry because every side has 2 entries. And most of the time, there are some scenarios when it wouldn't be, but 99% of the time, it'll always be 1 entry will be the P&L and 1 entry will be the balance sheet. Now, the P&L is a yearly thing. So at the end of each year, when you close the ledgers, the P&L closes to 0, but the balance sheet's an accumulated thing, and your profits for every year or your losses go to your retained earnings. So effectively, your balance sheet is an accumulated process. So the reason that is because that's then how you use your debtors and liabilities to work out now. The question is it a cash impact or is it a P&L impact? So, you know, if someone pays you, let's just say someone pays a deposit for something, let's just say it's £5,000 and they pay a deposit. What is the contract of that deposit? You know, if your contract T's and C's of your customer is, well, they can cancel up to 24 hours before with full money, then how do you record it? Now, the correct accounting treatment for that would be, well, it's not a sale then.
Yeah.
Because technically sales don't occur until you deliver the final service, especially if there's risk in contract that it could get refunded. So the 5,000 in that scenario, the double entry would be both the balance sheet, because it would come into the bank and it would credit some form of deposit revenue account or whatever you want to call it, deposit account. So that would actually sit as a liability. Now, it could be a bit misleading because theoretically, is it really a liability? Because will you have to pay that money back? But the reason it's there is because of the risk. So if you're then doing a cash flow on that, Now, if that's just one transaction, it's simple. But when you've got thousands of these transactions with all different types of clients, with people paying in advance, you having to refund people, who keeps track of those schedules? So how old is the deposit? And then are you releasing? And then what would happen on that 5,000 is at the point you then had the service and you didn't refund that money, then you release it to the P&L, and that's when your sale happens.
Yep.
And that is why we say management accounts are so important, because management accounts are by months, and months show trends. Yearly accounts don't really show trends. They can show a year-on-year comparison, but they don't show seasonalities. Only monthly accounts show seasonalities. And that is why it's so some people say, well, I can just adjust it at the end of the year. Well, you can, but then you don't see a trend.
Yep.
And the whole point of forecasting is forecasting is taking past information and using that information to plan the future. Now, if you have a trend of past information, you can generally do some form of certainty of what you think is going to happen. Maybe not on new strategies, but you can certainly on previous strategies, because there is, once you get 3 years of trends, if there is a trend, there is a guide.
Yeah.
And that guide becomes the forecast for the future. So when people get to a stage where they can never forecast, it's because they never actually analyze, because they don't really see the true trends of what's happening. Because if they were, they would be able to forecast. Now, then when you do new strategies, people go, well, I can't really forecast. Well, no, but you use educated guesses based on your knowledge of the industry and your knowledge of your previous business model.
Very good.
And that should be determining, well, what are your contracts? If your cash flow's tight, then I have to take deposits then. So you bring your contracts in based on your requirements of cash flow. You don't send the service out to market or products and then let people just pay however they want. You should be determining how people be paying you to manage your cash flow.
Very good.
And that's how we should be using it.
Okay, good. And of course, I think we often think, business owners often think that they're two completely separate things, the P&L and the balance sheet. And of course, they're not. They're linked very much by the statement of cash flows, and that's what explains how the two link together and how the cash flows in between, isn't it? So, okay, so let's have a think about acquisitions then, because we often work with business owners who are looking to achieve something. They're looking to scale to a certain point. And you mentioned before that often growth by acquisition is a way to help to accelerate that growth and to meet what we want to do. So what sort of things do we need to think about if we want to start thinking about maybe we should be thinking about acquiring a company?
Yeah, so we get approached by a lot. And I would always say to somebody, the most important thing I think is that you're ready. Because it's interesting, the amount of people that I see that go to buy businesses and then are sort of reprimanding the seller because they don't have this financial reporting. Yet, interestingly, the buyer doesn't actually have it themselves.
Right.
Now, because they haven't even set it up. So they're trying to say, oh, well, the seller's information is poor. But actually, the buyer doesn't actually have their own. So it's like the first thing we'd be saying to people is, we would definitely be recommending that people that want to buy should have their, if they're a business already, should have their own management accounts in place and their own cash flows and their own, profit reporting to know. Because if they're buying, most people are launching into something that's some form of add-on to their current business. Either it'll be exactly the same to buy new clients, or maybe they're diversifying a little bit. But if they don't even know what their own products or services are making in margin, how can they then track an acquisition? So what we normally say to people is, and what funding they need, because, there is funding, but people will often think they need funding and actually they don't. If they just did better internal management, they can find a lot of cash flow. I mean, we've seen things where cash has turned around 70 to 100 grand in a matter of weeks just by changing processes and the way they collect cash, which maybe is a short-term impact, because in the end it might average out, but it's still there. That's still good because you can get these hundreds of K and that can tie you over whilst you're doing things. So once they've done that, we'd always say, we'd be saying forecast your own plan and have a think about your own exit. So we'd be thinking 3 to 5 years or whatever normally that's the average time. What do you want your business to be worth? What would you want to sell it for? And then first of all, forecast your business growth based on your current strategies. So what happens? Can you get to your exit plan with your current strategies easily? And then there'll be a gap there, which normally there is, because obviously it is harder to grow organically than acquire. But that then helps decide, well, what type of business do you need? Because you could do 5 businesses of 200 grand, Or you could do one or two, or you could do one business at 1.5 mil and get to the same place. So then you've got to start deciding, well, what type of business do you want? What do you want the strategy to be? How will you fund it? What equity have you got to put in? And these types of things to then start the acquisition journey.
And what sort of mistakes do you commonly see people making in acquisitions?
Not having the right conversations with the sellers at the right time. So we find people will often say they'll get to heads of terms. So the process normally is you do deal flow, you find the business, you assess it, you get to heads of terms. Heads of terms is kind of like, some people call it, you have an LOI sometimes from the bank for your funding, but heads of terms is really, there's elements of it that are legally binding, but it's generally the basis of what is the deal structure. So valuation, sort of payment terms of that deal, and whether you're doing sort of, are you buying the balance sheet, are you not buying the balance sheet, like those types of things. And what we find is often the sellers don't have the information, and the buyer will rush through to heads because they want the deal, and they will kind of ignore the warning signs of, well, the information's not there. I'm like, well, if they don't have a management accounts ahead of time, they probably haven't got one. So they rush through. So they rush through heads, and they don't always get the right support, because they'll often go, "Oh, I want to spend as little money as possible," but they end up spending more money because they end up and wasting time. I've seen deals, people go, "Oh, it's going to close. It's going to close in a month," and the fact is, the buyer and seller aren't even on the same page. It takes 9 months because they don't have the information. It goes back and forth. Everyone's in too deep, and they want the business and they just carry on. And sometimes I have seen a few fall, but most of them, they do close in the end. But it's just hard work for everybody. And it's because they're not aligned. And really it's because often the buyers are doing an acquisition without the right financial support in the first place. Because going back to understanding financial statements is they're not having the right negotiation discussions at the front end. And the truth of the matter is, although obviously it can change because heads of terms isn't a legally binding document, the seller's obviously precious about their business and has an idea of what it's worth. And once you write that down on a piece of paper, it's very hard to change that mindset of what it's worth. Even if the facts come out of what it's worth, the fact is that can be very hard to change in terms of relationship wise, and, not in factual wise, but in relationship wise, which is why, we do a lot of upfront discussions, like commercial visits to sellers, analysis for people, just to assess, does it ring true? As an example, I remember once we saw someone's business plan. That was looking at it at before heads of terms, and they had a valuation, and we realised that their salaries in the P&L were 100k short to what apparently the salaries were on the business plan.
Right. So
when we challenged it turned out there was a whole nother entity cross-charging, changed the valuation by 450,000 just because 100k of salary. Because if you look at a 3.5-4 times multiple, because that's obviously the average multiple, there you go, 100k missing there. And the problem is, if you're not financially literate, it is hard to spot those things. Now imagine you've signed heads of terms and you've given them a price, and then that comes out. What happens? What are the discussions? What fees have you incurred? You've paid for your heads of terms for your solicitors.
Yeah.
I mean, or you've tried to draft it yourself, which a lot of people do, and then come to realize, I haven't put in my legally binding, because the legally binding element of the heads is normally the non-compete, the seller can't go to anybody else. So it doesn't benefit you writing your own heads because they write it wrong, and then they don't have their legally binding elements in it. So they've already now paid the solicitors for the heads, and for what? Because now they found the deal's 450k, who budgets? Like, what happens?
Yeah, and the seller thinks that the buyer is just doing their dirty and not sticking to what they said, whereas actually the buyer has now found something that is materially significant and fully justified in changing the valuation. Yeah.
And it just causes work and stress. Now, at the end, facts are facts. Do you know what I mean? They are what they are, and you can challenge them, but you've got to be willing to walk away. You've got to be willing to say no, because at the end of the day, things can come out. If you get too emotionally attached to them, it can become a problem, because people want it so much that they will just continue
Yeah.
And it's like, well, actually, there is big risks here. So all you can do is flag the risks, and then you've got to make sure you get the right clauses in your share agreements or asset agreements, depending on what you're buying, and get the right warranty. So.
Okay, so we've looked a little bit from the acquirer side, which is covered a little bit as well from the vendor side. But if I'm thinking of exiting my business in a few years, what sort of things do I need to think about in making sure that I get the maximum value for the business? Obviously, as you said, I need to get my financial reporting under control. What other things might I need to think about?
Well, I think the problem is, sometimes I can speak to 3 or 4 people on a business and they'll all value it differently. Because seller's gone down, spoke to his mate down the pub who sold his business, it's got to be worth the same. The fact is, businesses aren't like houses, really. Not one business is the same, even if it's a similar size with a similar industry, how it's ran. So often the operations of the business sometimes can make the valuation change, even if the value's there. So the reality is, a business has a set of accounts. There is facts, they have had 3 years worth of trade and there is a balance sheet. So you can get to an average EBITDA or profit, whatever you call it, and balance sheet, that is what it is. But then it's like, well, what is it worth? Well, then it comes down to, what does the seller want? I have seen businesses go for 10 times multiple, but the problem is all the fluffy stuff that a seller likes, a lot next to their seller. Oh, well, my employees have to stay. I want them to keep the name. I want them to keep the system. Well, normally a 10 times is probably a larger corporate firm and you're unlikely to get it. If someone's coming in, they've got the cash to pay it. So you've got to start choosing. Well, are you selling it, to a big multi-corporate that can just come in and pay you whatever and settle it quickly? You might not have to stay on because they've already got the resource. Or do you sell it to a smaller like a smaller buyer, entrepreneur, SME? That probably be more protective of the people and they get the fluffy stuff, but maybe the price is lower. So first of all, the seller has to decide, well, what's the value they want? That's why we say, what is the value you want? Because who you're going to sell it to makes a big difference, because nobody wants to buy a job. That's the problem. They want to buy an asset. Yeah. So if you are the key decision maker in your business, so even if you pay yourself good dividends, if there is no money left after the dividends, it isn't worth anything to an investor. Mm-hmm. Because an investor will want to pay you because you do the job and have a return for themselves. So that I think the key things are, when do you want to sell? How much do you want to sell it for? And who are the people around you that are going to help you sell it? I do think they're the top level questions. Okay. Obviously, within that, there's then some financial analysis and lots of detail that goes into the forecasting. But I think your management teams and your infrastructure and your vision are the most important things, because, that will determine, because you might be able to say it to a big corporate and sell it quicker because maybe they won't be as bothered. But there will be harder things that come from that. Yeah. That wouldn't come from a smaller, and you've got to make those decisions. Yeah. So
we've also got to be clear about who might be the potential acquirer, because you say there might be a difference between a big corporate and an SME. There might also be a difference between somebody that might value something a bit more strategic about what you've got and not just simply value it on the cash flow, on the EBITDA.
Yeah, and some people are, especially in tech and IT, they're often forecasted based on their IP and their future benefit. But then understanding your accounts, because I've seen it in tech, where we've been asked to look at things like adjusted EBITDAs for R&D as an example, because your adjusted EBITDAs would be things like one-off costs that might be impacting your average profit, which are warranted. Yeah. But you've got to know where they're sitting, because we've seen it before where people said, oh, my R&D's in my P&L, we do want an adjusted EBITDA because we think it will increase the profit. When we came to review it, the accountant had already capitalised the R&D. It wasn't in, because they didn't have a management account, they were only using the year-end account, so it wasn't even in the P&L. Changed valuation by 4.5 million. Right. Just by them not knowing where had they put the R&D costs. And this is what people say when they say they can triple the value of the business. No, because obviously the business owner can't calculate the R&D. They're not going to be tax knowledgeable enough to do that. But to not even know that it was capitalised is the problem, isn't it? That's the understanding bit, is understanding what is the difference if I P&L my R&D versus capitalise. Yeah. In terms of, what does that mean for my tax? What does that mean for my valuation? What does that mean for the future of our business? Because otherwise, people have gone for 4 or 5 years just thinking, oh, it's okay, 1.5 mil of R&D, and actually it's not there. Yeah, yeah. So between 4 and 5 mil, the value of in their mind, it drops. It hasn't really dropped because it is what it is. It's always been the same, but it's what it is to the seller. And why would you want to get to the point where you want to sell and see that? Why would you not want to start looking at that a bit earlier? Yeah. And this is what we try and say to sellers is, if they just switch their mind and invest a little bit more for the 3 or 4 years before they sell, they just don't need to get to that place, because we're going to know, and they have to be open to the truth. If the truth is it's not worth that, then if they want to get to that, then they can start doing something about it.
Yeah. Good. Well, I think we could explore a lot more about acquisitions, obviously, which is why you've got your podcast. Remind us what your podcast was called again. The Build and Exit, is that right?
Yeah, the Build and Exit. Yeah.
Brilliant. So people should listen to that, certainly if they want to know more about acquisitions. So you up for a couple of quick fire questions before we close, Julie?
Yeah.
Good. So if you go back to your younger self, what advice would you give yourself?
I was doing this with my coach actually the other day. So, because I go back and I look and I talk to my younger self actually in the coach sessions, which probably sounds a bit weird, but that's what you do. And I think I've been working on like fear. So sometimes we have fear of things, and it's understanding why, because we fear for the future. Because I know from all the meditation I do that, if we're making our decisions from our unconscious mind, we're living in the past, not the future.
Yeah.
So it's basically, which I've learned through my meditation, would be to be more in the present now.
Okay, brilliant, good. Any, obviously your own podcast, but any other podcasts or books, any learning resources that you would recommend to people maybe want to know more about acquisitions and exits?
I don't know if I've seen any podcasts. Oh, well, yeah, because there's Paul Quirk.
Any particular apps or bits of technology that you love?
Well, we have all the standard ones. I won't name them because I'll probably get sued or something for promoting, but all the softwares, all the accounting softwares. I don't have any apps really though in acquisition so much. All
right. Do you do a mindfulness app or anything like that? Or
well, I do a lot of mine from YouTube, to be honest.
Right. Okay. Yeah. All right.
YouTube. So just like Google them. I like a Diary of the CEO podcast. He has some good,
he's great,
functional doctors on there.
Yeah, very good, excellent. What's your most successful marketing tactic? Or most successful way of finding new customers?
Oh, definitely the podcast.
Definitely the podcast. All right, brilliant. Good. Well, Julie, I've learnt a lot. I had a great time talking to you. Thank you very much for being my guest on ScaleUp Radio today. If people would like to get hold of you or find out more about Wilkinson's, what's the best way for them to do that?
Yeah, so I'm on LinkedIn. I'm Julie Wilkinson, our profit queen at the end.
Yes.
You've always seen it. We've got our website, Wilkinson Accounting Solutions. We're also on TikTok, and Insta as well.
Brilliant. Superb. Julie, thank you very much indeed for being my guest today.
Oh, thank you for having me.
I hope you enjoyed that discussion. And if you're building and scaling your own business, you might well be interested in our book, The Entrepreneurial Scale-Up System. And it's exactly what it says on the tin. It's a practical handbook around scaling a business in a structured way. And you can order a copy on all your favorite online retailers, including an audio version, or you can find it and other supporting resources on our website, www.esusgroup.co.uk. That's esusgroup.co.uk, which is esusgroup.co.uk.
This has been a Monkey Pants Productions podcast.